Okay, hello, you trader nerds and all of you at the University of West Georgia. Go Wolves, baby. We are ready for another day of portfolio management. That's what we do here each and every day. And we also want to talk to you a little bit today about covered calls for my West Georgia students. All right, so let's see how the market is doing today. Always nice to see how the market is doing. So the E-minis are down 3.25 points, down 0.07%. That's a nothing burger. So we are right at where the cash open was today at the 5,013 level. No volume at all. Look at that. Volume is dead. Nobody's really trading a lot today. AD is bunching up while the price is doing this. So what we would anticipate is for price to pick up and to do exactly what the AD is doing and follow along. So I would imagine that we're probably going up at some point today, but it has not happened yet because we have divergence here. AD, the advancers over the decliners are going up, while this little thing is just kind of going back and forth and back and forth. So it'll be interesting to see if indeed the stock or the E-minis actually start following the direction of AD. Let's look at the Big Green Monster. Big Green Monster, we are overbought for the fair value zone below us, which means we believe that probably price should come back into this area within the next 10 days. So where these pockets of volume have not been traded. So anyway, we'll see what that does. But on to the account. So we're going to trade the mega account today. And today is the 8th. Now, y'all are going to get scared here. Last time we had 463,462. Today we have 373,519. Oh my gosh, we lost $100,000. 373,522. Let's put that in there. 373,522. That looks really, really bad. So we lost 100,000. We lost 89,000. No, we didn't. No, we didn't. What we actually did is we moved $100,000 out of that account. So that is not a loss. So let's make this 363,462. 363,462. So we are up. 363,462. So we are up. What is this thing? What did that do? Hold on a second. Let me fix this. We're down 363,462. There we go. There we go. So we're up. No, we're not down 89,000. Let's see. 363. Oh, 363,462. 363,462. So we're up. Is that right? 14,000 on the year? I got to double check that. So that's good if that's the case. If we actually went up $10,000. So I don't know. That doesn't seem right. I'll have to check that. I'm pretty sure I transferred 100,000 out though. But anyway, nonetheless, we are doing good, baby. So let's see our trades. Now today is so fun, y'all. And watch, for those of you that get my latest spreadsheet when it comes out, we now have the position sizing on this. Look at this. So it tells us where we should be. So it brings in automatically your net lick. We have to put in the information in the yellow, and a 112 trade that we do takes up $12,250 of buying power. We want to be at 50%, and we began on 11/1/23. Now, what's this? Today, you and I, based on this, should have 14 positions. After we finish today, we should have 15 positions. Let's see how many we have. We actually have 14 positions. After today, we'll have 15 positions. So we are right on track for that. So let's go in and record our Greeks and ratios. If you'll remember from my interview with Tom Shoshanoff, that this is what we do. We measure deltas, we measure theta, and we measure our buying power. So let's look at that. Our theta in this account is, make sure I get to the right account right here. Take that off and go there. Make sure that's the only one. I got too many accounts here that I'm juggling. Make sure that's the right one. Good. So our deltas are 294. Theta is 363. 294, 363. 294, 363, which means this account has the equivalent of 294 shares of SPY. That's what a beta weighted delta is. And theoretically, all things being equal, we should be making $363 a day through the decay of those options. The VIX is at, I guess it's 13 still. Let me check. The VIX is at 1296. Let's put 12 in there. VIX is at 12. And our buying power usage, remember, we have to look at our positions and take bill out of it, right? Because we've got 195 in bill. So we've got 141,000 that we're using with our options, 141,000. So we're only using 37%. We could be up as high as 50%. Okay. So everything is looking good. Now, in this position sizing, you remember we started in this account back on November the 1st. Remember, after 15 weeks, we are at a point where we should be, I should actually be at $186,000 of buying power. So this is a little bit low, my buying power usage, which is probably the result of the Sweet Bobby hedges that I have on this account. So what we're going to do is we're going to put on a 112 account, 112 trade, right? We're going to do that. And then we are now at the point, y'all, of rinse and repeat. Let's go through that for our new West Georgia students so that you know what our plan entails. Remember, there's 5 steps of our plan. So the plan is, number one, oh, come on, don't give me trouble today, not in front of all my friends. Here, I'll just start drawing here. Remember, step 1 is, darn it. Here we go. Step 1 is we sell premium, sell options premium. That's what we do. We sell options and collect premium. Collect premium. All right. The second thing that we do is we do those trades at a high probability of success. So most of my trades are 90% probability of success trades. And then the third thing we do is just wait and allow options to decay. Remember that theta of 363? That's the amount of decay that we should experience on average per day, even though it's not linear. 4, we manage chaos. And basically, our only risk in this strategy is tail risk to the downside. If we have a big, humongous move to the downside, a 20% move in the market to the downside hurts us a lot. And then the fun part of the strategy, oh, this is the fun part. We just rinse and repeat, baby. Rinse and repeat. Okay? Rinse and repeat. And that's what we're doing today. So now I have got this account built up to where I will put on a trade and then I'll take off a trade. Put on a trade, take off a trade. So let's see. Let's go over here and let's do our 112 trade. Now, this is the 112 that I was talking about with Tom Sosnoff, or the 111s or 112s. So make sure I'm trading the right account. You want your T to be in that right account. And we're going to go to Trade tab. We're trading the E-minis. I go closest to 120 days. So 120 days, we got 113 or we got 133. So that's 7 days away from 120, and this is 133. So we're going to do 113 days. And the naked component is selling 2 puts. That's the 112 at a 5% probability of being in the money, or the equivalent of a 5 delta. So we're looking at a 5% probability of being in the money. That's the 4,200s. So we're going to do 2 of those. Do quantity 2. And let me clear that. We got a lot of stuff selling there. Again, 5% probability of being in the money. We're going to do quantity 2. And we're going to try to get 1475. We're probably not going to get that, but let's see if we got it. Wait a minute. Now, here's the thing. It's saying that I don't have the stock buying power to do this, right? So it's probably going to say it's an illegal order. Let's see. Yep. The account does not have sufficient buying power available for this order. Margin check failed. The reason is because we moved that capital out, and then we can't do it because I actually sold Bill as well, and it looks like they've not put the buying power back into the account yet. So it doesn't look like it's going to let me put on a trade. That's fine, because here's another thing that I wanted to show you though. All right, I'll have to wait a day or two. Maybe tomorrow that money will be clear and we'll be able to do it. But what's this? So today we should have put on a trade, but this, where we actually list our trades, tells us it's time to close our oldest trade. Look at this. This is our naked put one that we put back on November the 3rd, right? November the 3rd. We've been in it for 97 days. And when this thing gets down to 21 days, the close signal comes on. So that's the rinse and repeat. We close a trade, we put on a trade. We close a trade, we put on a trade. So let's close this 3,500 with 21 days left to go. Let's go here. Let's go to our positions and ES. Naked put one. I should have it labeled in there. If y'all see it, stop me. Naked put one. Where are you? There you are. 3,500s. We got 4 of those. And they are at 97.5% profit. Check that out. And our rule says close them when they're at 95% profit or they're down to 21 days. So let's close these 4. Close positions, all 4 of them. And we're going to try that for 30 cents and probably not get filled. So now we've got to make that less advantageous. So we'll bump it up to the 35. That should fill. And we are out, baby. Rough. Yeah, that's how you do it. Now let's see if we made enough to take the kids to Applebee's. I got a family of 7. Can we go to Applebee's on what we just closed? So let's see. We closed those for 35 cents. And we closed it on the year of our Lord. I'm not sure that was 4 of those. Yep, 4 of those. And we closed them in the year of our Lord, 2/8/24. So we made $2,565.44. Yes, Lord, we can go to the Applebee's for that. So that's how much money we made on that trade. Isn't that great? Isn't that wonderful? So now, let's see what our buying power is now. So that increased our buying power. I'm thinking tomorrow I'm probably going to have buying power to put on the new trade. So I'm sorry that you didn't get to see the new trade today, but that's exactly how we do it. You take one off, you put one on, except I got to wait for my buying power to come back on. Any questions on the 112 trade? Taking profits? And the good thing is, look, I've got a put debit spread that was associated with that. See, this is a put debit spread one that is left there for another 21 days without a naked put attached. So this trade has 0 risk to it, really. This is a wonderful thing. Rinse and repeat, y'all. Rinse and repeat. All right. Now, so that's that account. Let me talk to you about what I wanted to do with the covered call today. So my little guys in West Georgia, y'all are supposed to be selling puts on companies that you want to own. Now, remember, make sure that the stock that you trade has 1 million shares traded every day. How do you see that? Go over here. And let's say that you're going to trade Amazon. And I'll show you that Amazon has enough. AMZN. Right? Here's the volume, 27 million shares. Does that meet the criteria? Absolutely so. Right? So you would go over and say, I'm going to do an 8-day option. And if I told you to sell the 30 delta or 30% probability of being in the money, then that is right here at about this 165 or the 167. The second thing I want you to look at is a tight bid ask spread. Bid ask. You sell on the bid, you buy on the ask. Those are 1 to 2 cents wide. See that 136, 137? They're 1 cent wide. That's what I want. If this thing were like $1 wide, you would not do it. So you could sell the 167.50, right? Confirm and send. You're going to bring in $135 in credit. after your commission's 134.45, buying power $3,000, y'all know how to sell a put. Now, why I'm letting you do this on like 5, 7, or 8 days out is I want you to be assigned. I want you to actually be assigned shares. So if the price of Amazon is below 167.5 at the expiration, or it can even, you can be assigned before expiration, then you're going to be put 100 shares of Amazon. Okay, then what do you do? So after you are put shares, you'll wake up and you'll say, oh, I actually own stock. And they'll say 100 shares that you own of Amazon, right? 100 shares. The next thing you do is you're going to sell a call against the 100 shares. Now, this is cool, y'all. What's this? So what that means is this. Let's go show you how to sell a call looks like. So what you would do is you would not go on this side. This side is the puts. You would go on this side, which is the calls, and you would sell an out of the money put. What does that mean? A put that is above the price of where the stock is. The stock's at 169. Go out and sell a 30 delta, around a 30-something% probability of being in the money, 2 cents wide. You're going to sell a call. Now, what's this? Sell a call, you would get $131. It says your max loss is infinite. Well, that's not really true if you own the shares. Now, if you don't own the shares, yeah, you have unlimited liability, because if Amazon were to go up to, from 169 to 200 or 300 or 400 or 500, you're going to be losing a lot of money. But in this case, you're selling a call against the shares. Now, what's this? What you have basically done, let's take it as far as real estate. Let's say that you own all that land over there that I'm looking at my backyard and pasture. And you go, man, I'm paying property taxes on that. I'm just holding it. I don't do anything with it. And then all of a sudden, Farmer Dan comes up to me and says, hey, Bobby, I would like to rent your land and put cows on it. And I say, okay, how much will you give me? He says, I'll give you $1,000 a year. And I say, sold. I wasn't using it. So I let him put cows on that property. And I have brought in $1,000 of income. That's what you're doing with a covered call. You own the stock's just sitting there, and then you sell a call against it, so that if the price of Amazon is below your 172.5 at expiration, guess what happens? You get to keep the $131 and you get to keep the stock. But if the price of the stock goes above your 172.5, and it can happen before expiration that someone might call your stock away, but definitely at expiration, your stock will be sold and be called away from you. Does everybody get that? It's called away from you. Remember when you sold the put? You sell the put, if it goes down below the strike price and it's at expiration, you're going to be put 100 shares of stock. You will own that. So in this instance, if the price is above the 172.5, your shares of stock will be called away from you. This is something that we call the wheel. This is what a lot of people call this. This is the wheel. So you either get to keep the premium and the stock, or you're going to be called away on your stock. They will call it away. Take it away from you. You don't have to log in and sell your stock. It will be ripped from you in the middle of the night. You will wake up in the next morning and go, wait a minute, I thought I had 100 shares of Amazon. And all of a sudden, your Amazon shares will be gone like a thief in the night, baby. Okay. Now, let's say that you like the stock. What would you then do again? So now you would rip around and say, man, I love Amazon. So then you're going to sell a put. Isn't that cool? So you sell another put, out of the money put, maybe a 30% probability of being in the money. You collect income. Then you say, if I'm put the stock, I'll buy the stock. Then what do you do when you get the stock? You sell a call. It's a nice little circle. Let's just draw a circle. Sell a put. Your put shares. Then what do? You sell a call. If it's above your stock price, if the stock if the stock goes above the stock price, then you are called away. They call your shares away. And if you still like the stock, what do then? You sell a put. Everybody see this? It's the circle of life. Remember the Lion King, baby. That's all this is. Sell a put, get put shares. If you're not put shares, you get to keep the premium. But if you're put shares, then you sell a call against it. If you're not put shares, what do? You sell another put. You just collect income. This is what we call the wheel. And normally, Tasty Trade Research says to do this around 45 days to expiration on your options. But we got a short class, y'all. I want y'all to be doing this every day. That's why I'm selling sell options that are like 5 or 7 days out there, 8 days. Sell these short-term options so you can see this in action. Any questions on the wheel? Let's see what y'all saying. Can you go back to the first 5 steps for 1 second? Sure. Why is the criteria 1 million shares a day? Because you want the stock to be liquid. You want the options to be liquid. You want a lot of interest in it. Now, I'm not going to hedge that. I'm not going to hedge this because I like the stock. So if the stock is trading at 100 now and I sell a 95 put and I like the stock at 100, I'm going to love it at 95. So you don't really have to hedge it. So that's why the criteria is 1 million shares. You want a tight bid-ask spread. The number one thing, if I were to say, if you're going to sell options on a stock, what's the first thing you should look at? Liquidity. Liquidity. How many people are trading it? You want at least 1 million shares traded during the day, and you want to make sure that that bid-ask spread on the options is tight, baby. Now, it may be a nickel apart the higher price stock is, right? So, if you got a higher price stock, it may be a nickel apart. That's fine. You don't want dollars apart. The bid being $1 and the ask being $3. You want a tight bid-ask spread. But most of the things that you guys are going to be trading will be the most popular stocks in there. Okay, so Siphon, you wanted me to go here to the 5 steps. You want to get a screenshot of that or take a picture with your phone? We sell options. We collect premium for selling those. We do it at a high probability of success. My trades are all about 90% probability of success. We allow that option to decay. We call that theta. We collect that about every day, even though it's not linear. Even though my theta is 363, I may get $200 of decay tomorrow, and I may get $500 the next day. It's not linear. It's not 363 a day. On average, that's what it should be. But those options decay. We manage chaos if the market moves against us. If it moves towards your strike that you sold, that's chaos. How do you manage chaos? Well, you close a position, you take your loss, or you roll it out farther. And we'll talk about that next week, rolling out farther to extend duration of your trade. That's one of the steps of managing chaos. And then it's rinse and repeat. Got it? All right. Any other questions at all? Emily's still in here. Emily was up $4,000 the other day, y'all, like on a single day. She was doing in her paper money account. Emily, how much are you up today? You still up? No, she's not up. Okay. All right. That's fine. Oh, you're up $1,700. That's good though. What about your year to date, Emily? Is that your daily amount that you're up, or what's your year to date? It should over the side say, okay, that's your daily. What's your year to date up? You ought to be up like 6,000 or so now, right? Probably. Okay. Yeah, look and see. Are anyone got any questions at all? anything at all, I'm here for you. I want you to learn. All right, guys, great session. Thanks for watching. I will see y'all Tuesday. I will see my trader nerds tomorrow. Y'all be good and blessed.